car seller CarMax, symbol drop in profit more than 50% as sales rose just 2%.
Shares down here early in trade by about 16%. And particularly, they talked about some of the combined retail and wholesale used vehicle unit sales.
Big task is just to make sure that we have plenty of inventory that consumers want.
What if I told you the foundation of car ownership in America is starting to collapse? No exaggeration, no scare tactics, just cold, hard truth. CarMax, the largest used car retailer in the United States, just lost 47% of its value in a single day. Nearly half of its worth wiped out. But the most alarming part? The CEO of CarMax came forward and said, "We don't know what's coming next." Think about that. This isn't a small player making a desperate statement. This is a billion-dollar giant. A company that sells over 1 million cars every single year. A company that's been around since 1993 with 240 locations spread across 41 states. And even they don't have a clue what's around the corner. That's terrifying, because if CarMax, with all its resources, tech, and data, is this uncertain, what does that mean for the rest of the industry? What happens to the smaller dealerships, the independent sellers, the everyday car owners trying to trade in or buy their next vehicle? Are we looking at the beginning of the end for the car retail business as we know it? It's time to look deeper. Because this isn't just about one company's bad day on the stock market. This could be the signal of something much bigger, something that might just upend everything we thought we knew about buying and selling cars in America. Let's find out what's really going on. On July 2nd, 2025, shockwaves rippled through the entire American automotive stock market. CarMax had just released its quarterly earnings, and the numbers hit harder than anyone expected. At first glance, things didn't seem too bad. Earnings per share came in at 58 cents. Net sales reached $6 billion. Both were up from last year's 32 cents and $5.63 billion. But here's the problem. It wasn't enough. Wall Street had been expecting 68 cents per share, and in the world of stocks, expectations are everything. Miss the mark and investors panic. Confidence disappears. And when that happens, the market responds with brutal precision. That's exactly what happened to CarMax. A massive sell-off hit the stock like a tidal wave. Shares that started the day at $68.50 nosedived, closing at just $35.92. In a matter of hours, CarMax lost nearly half its value, 47%, gone in one day. And this wasn't just a stumble, it was a warning shot, one that rattled the entire automotive retail sector. In simple terms, CarMax lost $3.2 billion in market value. Just like that, wiped out. But the damage didn't stop there. CarMax didn't fall alone, it dragged others down with it. Carvana, Vroom, AutoNation, all major players in the used car space, saw their stock prices crumble. Carvana dropped 12%, Vroom sank 18%, even AutoNation wasn't spared, losing 8%. It was a domino effect. And honestly, it makes sense. CarMax is the king of used car dealers in America. If the king can't sell, what hope is there for the rest? Analysts had expected CarMax to sell about 312,800 used vehicles during the quarter, split between 185,900 retail sales and 126,900 wholesale units. But when the numbers came in, they told a different story. Just 301,811 used vehicles sold. Retail, 182,655. Wholesale, 119,156. All of it below expectations. So what's really happening? Across the country, dealer lots are starting to look like graveyards. Cars are sitting there longer than ever. Some are even collecting dust. And the real twist? It's not just about declining sales. Because when a company misses targets, that's one thing. It happens. Usually there's a roadmap, a plan, a vision for recovery. But with CarMax, there's silence. No roadmap, no strategy, no confidence. And that's what's making investors nervous. Because when a giant like CarMax starts to stumble and doesn't know how to stand back up, it's not just a red flag, it's a siren. Bill Nash, the CEO of CarMax, didn't hide behind vague corporate talk. He came out and said it plainly. We are suspending all long-term growth targets. We simply cannot predict with any confidence what the next 12 to 18 months will bring. That statement alone sent shockwaves through the market. This is a man who leads the most data-driven used car retailer in America, a company built on forecasting trends and managing massive volumes. If he doesn't know what's coming, no one does. That single sentence is what triggered the panic. It's why investors ran for the exits. And it's why $3.2 billion in market value disappeared in a single day. But the cracks run even deeper. Nash also admitted that CarMax is facing a serious inventory problem. Not because of poor planning or bad purchasing decisions, but because people simply aren't buying. Cars are sitting unsold. Overflow lots are packed. Employee parking spaces are filled with inventory. Some vehicles are even being stored in driveways. The neat, orderly structure of CarMax's lots has turned into something closer to a cluttered storage yard. And then came the most alarming sign yet. CarMax increased its loan loss reserves to $117 million. That number assumes the economy stays strong. But if unemployment goes up or interest rates climb just a little, the losses could become catastrophic. This isn't just a rough patch, it's a signal, a warning that something bigger may be brewing in the American auto industry. When you connect all the dots, it starts to make sense why Dr. Sarah Chen from Moody's made a chilling comparison. She said, CarMax is the canary in the coal mine. If they can't see what's coming, no one can. And she's right, because if a company as massive and data-driven as CarMax is flying blind, what hope does the rest of the market have? But the big question is, why? Why is America's most advanced car retailer suddenly failing to read the room? Why are car buyers no longer walking into CarMax lots? The answer, surprisingly, is simple. CarMax is buying the wrong cars. It sounds almost ridiculous given all the data they have, all the algorithms, all the resources. Yet somehow they've missed the mark. Their lots are packed with cars priced between $25,000 and $35,000. Meanwhile, the average American buyer is hunting for something far cheaper, closer to $15,000. There's a massive gap between what's available and what people can actually afford. But that's just one part of the problem. CarMax's own financing arm, CarMax Auto Finance, has made things even harder for buyers. They've tightened the rules. Where a credit score of 580 used to be enough, now buyers need at least 650. On top of that, the debt-to-income limit has been lowered from 50% to just 40%. In simple terms, fewer people are getting approved for loans, and fewer approvals mean fewer sales. Each deal becomes harder to close. The profit margins, thinner than ever. And the impact is being felt hardest where it hurts most, CarMax's biggest markets. From Texas to Florida to California, buyers are being priced out. They want cars, but not at these prices, and not with these loan terms. CarMax may still look like a giant, but underneath, it's starting to buckle. The real question is, when did this collapse begin? Because let's be honest, it didn't all fall apart on July 2nd. According to several analysts, the signs were there months earlier. And here's the kicker, CarMax knew it. Internally, the company saw the red flags, but instead of addressing the root problems, executives pointed fingers elsewhere. The blame? It landed squarely on Donald Trump's 25% tariffs on imported vehicles and what they called challenging macroeconomic conditions. In other words, they said customers were feeling uncertain and choosing to hold off on buying cars. But let's break that down. CarMax isn't in the business of selling new imported cars. It's a used car retailer. Their bread and butter is domestic, pre-owned, and off-lease vehicles. So logically, if tariffs were making new imports more expensive, demand for used cars, CarMax's entire inventory, should have gone up, not down. Instead, the opposite happened. Sales fell, traffic slowed, inventory piled up. So the tariff argument, it doesn't hold much weight. This wasn't about politics. This wasn't about macroeconomics. This was about a company making the wrong calls and hoping no one would notice. The truth is, this collapse didn't start with Trump's tariffs. The cracks were already showing long before that. By the fourth quarter of 2024, CarMax's sales were already falling. And by the first quarter of 2025, something even more alarming happened. CarMax's loan loss provisions spiked dramatically. That's a clear sign. More and more customers were defaulting on their auto loans. And let's be clear, those defaults had nothing to do with tariffs. They had everything to do with affordability. For years, CarMax had been riding high on the post-COVID car boom. The company focused on selling higher-end used SUVs priced between $25,000 and $35,000. These were the big margin vehicles that made their quarterly numbers look good. But that strategy may have finally hit a wall. Today, those expensive cars are sitting on the lot, unsold, unwanted. Meanwhile, buyers are searching for something more reasonable. Vehicles in the $15,000 to $20,000 range. That's what people can afford right now. But CarMax doesn't have enough of those. In short, they bet on the wrong market. Now they're stuck with billions of dollars in inventory that customers can't buy and banks won't finance. What was once a winning formula has now become a massive liability. But perhaps the worst mistake CarMax made came when they tried to keep the sales machine running at any cost. As the economy began to tighten, instead of playing it safe, CarMax did the opposite. They loosened their lending standards, and that opened the floodgates. Suddenly, subprime loans to buyers with shaky credit, were everywhere. At first, it might have looked like a lifeline, but it quickly turned into a nightmare. Defaults surged, cash flow started drying up, lenders began to lose trust, and investors, they started pulling away. So when the CEO pointed to tariffs as the problem, it was never the full story. It was a convenient excuse. The real issue is this: CarMax overreached. It chased a high-margin model that no longer fits the reality of today's buyer. It sold cars people couldn't afford and financed buyers who couldn't pay. Now the consequences are unfolding in real time. That's why the CEO said he doesn't know what the future holds, because deep down, he knows this isn't just a bump in the road. And if you think this crisis stops at CarMax, think again. This is about the entire automotive market. CarMax's own data shows a clear pattern: falling demand, rising loan defaults, and a mountain of overpriced inventory. And it's already starting to spread. New car dealerships are watching trade-ins disappear. Major lenders like Ford Credit and GM Financial are pulling back. Banks are tightening up auto lending across the board. And when that happens, when financing dries up, car prices don't just dip, they crash. And most people won't even see it coming. The question now is no longer if there's trouble, but how bad it's going to get. Will this be a soft landing, a hard crash, or the total collapse of auto financing as we know it? And more importantly, what does it mean for you? Here's the harsh truth. If you already own a car, its value is likely headed for a steep decline. As loan defaults rise and repossessions flood the market, used car prices could tank, especially for higher-end models. Demand is shifting quickly toward cheaper, more practical vehicles. And if you're planning to buy a car soon, timing is everything. Wait too long, and financing might dry up completely. But rush in too early, and you could end up overpaying for something that will lose value fast. This isn't just a CarMax problem. It's a warning to the entire auto industry and to every car buyer in America.